Hey, so here we are in what is the second sort of installment of the financing section. And what it really means is when companies, it's again corporation focused. So, how do corporations raise money? And what are the journal entries involved around issuing shares to raise money from investors? And then how do we adjust and handle all the things related to that, paying dividends, et cetera, et cetera. So, and as well as the section, how to present that, because it can actually be a very complicated section on the balance sheet for a corporation. So you shouldn't be leaving a grade 12 accounting course without going into the future business world or business education without some idea of how to look at and read the equity section of a balance sheet for a corporation, because it's quite different than just capital like it is for sole proprietorship in grade 11. So, as you can see, this is equity part 1, and there's a few exercises and solutions as you work through them if you're having trouble. So, what I'm going to go through is this slide here. So, first part of equity financing. So, some of it's review. The first slide, I can't even remember what my point was with this slide. I think pretty much if you've taken grade 11 and 12 accounting at this point, what you should have covered: how to do a business for a service business and a merchandise business with different legal forms of ownership: sole proprietorship, partnership, corporation. The only thing you don't know how to do is manufacturing. And I don't know why corporation manufacturing is highlighted. I think it's because once upon a time I used to do that if there was enough time in the course. But so that whole manufacturing row should be blank. You don't learn anything in this course about that. I think that's what this slide was about. Not that important anyway. What is important is this concept. So a corporation has several advantages that you would have covered in like a grade 10 intro to business class, as well as you should have covered it in grade 11 accounting too, right? The different pros and cons of the legal forms of ownership: corporation versus partnership versus sole proprietorship. One of the main advantages of a corporation is the fact that you have this sort of veil of protection, right? That there's this limited liability, that whatever the corporation gets involved in, it's the corporation's responsibility, not you, the owner of the corporation. And that's because in most countries in the world, a corporation is viewed as a separate person, as its own individual, which it has some advantages, because like if you invest, say, in a large corporation and that weren't true, you personally and your home and your boat and your cottage would be on the hook for all the debts of that big corporation. That's not the case. You only risk the shares that you buy into that corporation. That's all you can lose, whatever you paid for them, right? That's because of that corporate veil, right? It's called limited liability. Some of the other advantages, though, is that, and I guess it could be a disadvantage, but generally it's considered an advantage, where management that runs the business and ownership is separate. And ownership can change without affecting who's running the company. And who's running the company can change without the owners changing. As well as corporations go on forever. They don't die when the owners die, right? As the sole proprietorship does. So, again, that creates pros and cons too, I guess, right? The one on the screen is showing you that these is the reason you can't walk, if you own shares of Apple, the reason you can't walk into an Apple store, take something off the shelf and say, I own shares in this company, this is mine, I'm taking it. Because it's not actually yours. Because the assets that the corporation owns, the idea is that a corporation is a separate entity, a separate person in the eyes of the law that can do everything a person can except vote or have kids, right? So they can sue, they can be sued, they can hire people, they can fire people, they can enter into contracts, they can buy other corporations, invest in other corporations, they can lend money, borrow money, all of that. So this corporate person owns assets like factories and things, right, to run a business. But the corporate entity, the concept of the corporation that owns these assets, are owned by then shareholders. But the shareholders don't own the assets. They have a right to the value, ultimately, of the assets through the corporation, but they don't directly own the assets, those investors. They own the corporate shell, and that corporate entity, that shell, owns those assets. That's how that works. That's why there's that corporate veil of liability. But it also means there's double taxation. So when the corporation earns profit from using those assets to generate revenue and make profit, it pays corporate income tax. And whenever it passes on what's left to its investors, a separate person, the investors pay tax on those dividends again. So that's a disadvantage, which is what the second slide was about, right? These assets here earn money for the corporation who pays tax on the profits. If they pay a dividend then to the shareholders, they pay a tax on the dividend. That's the dealio, right? So here's some pros and cons. Most of the review should be from grade 11. You can read that as well as me. I can say it in a video. So I'll leave that to you. If you have questions, I'm sure you can email me those babies. Same with this one. There's pros and cons to the corporate form. Okay. Again, you can read that. Not that important. Here's what matters. And this really only becomes clear when you see an example. So now we're into the section, the actual equity section. Corporations have two types of shares. And remember, if you own a share, you own a piece of the corporation. Right? You have a claim on the wealth of the business. And there's at least two types of shares. The most common are literally common. And you have different classes too of shares. We're not even going to get into that. But there's common and then there's preferred. So there's two different share types. And those are the two those, you're going to see the accounts. And then there's a retained earnings. Those are the three most common that you'll see in the equity section. So the next characteristic about each share class, so preferred and common share classes, those accounts are how many shares the board of directors of a corporation, because corporations have a board of directors, right? In fact, most of the organizations you know of are actually structured as a corporation, including the city of, say, Burlington, right? The city of Burlington is a corporation, right? So town council is the board of directors. And then the executives, like the CFO, CEO, they have people. They have executives that are chief financial officers and people they hire to do those jobs, the counselors, right? Or, yeah, I think they're called counselors. Some townships have reeves, right? But they're the voters, of course, are not shareholders. They're people who live in the city. But otherwise, it's structured like a corporation. Most organizations are, even charities. So, authorized shares, how many shares the board of directors has authorized to be issued, period, in total. Issued and outstanding are how many actually have been issued. So if you're trying to calculate earnings per share, you don't care how many have been authorized, you care how many that have actually been issued. All right? Preferred shares. So as the slide says, preferred shares are called preferred because of a couple of reasons. The first is that if you're going to pay a dividend, the preferred shareholders must be paid first, fully. If there's nothing left for common shareholders, then too bad, right? Often, preferred shareholders also have a guaranteed dividend, so that if you are not able to pay them, when you resume, you have to make up all the lost time, all the lost years of dividend payments before you can pay common shareholders anything. That's often the arrangement. Second, if for whatever reason a corporation is not successful and doesn't survive and it goes bankrupt, then the preferred shareholders get their money back before common shareholders. So they all have to get all of their money back before a common shareholder gets a dime. And that usually doesn't happen ever. Usually the shareholders are out totally, right? Because the bond holders and the government get their money before any shareholders. So I don't think we don't need to really talk about this slide, so you can probably skip it in this course, right? It's not that important. But this is where things start to get important. The way you actually record in accounting the issue or payment of shares. So when a corporation wants to raise money, so financing with issuing shares, what they have to understand, which they obviously collect money and they create more shares. So because of certain legal situations, what you have to understand is there's actual legal capital to ensure that you don't issue shares and take the money and go away, pay a giant dividend or pay yourself a giant salary as CEO and go to Tahiti for 10 years, right? So there's something called legal capital, as it says, and legal capital has to be retained in the business. It can't be paid out in dividends or otherwise, right? So you must retain legal capital. So legal capital is determined as follows, it says up here. Shares can sometimes have a stated or par value, and there's a slight difference, but in this course we don't care. We're going to say stated value or par value of shares is the same thing. So if I'm going to issue my shares of my corporation and I'm going to say, yeah, these have a par value of $1. $1 is the par value. Then that is the legal capital. Sometimes that's not done anymore. Quite often it's not. So if shares are issued and they have no par or stated value, then the entire amount of money you collect from their issue is what's called the legal capital. So all you have to remember is the legal capital is what has to stay in the business. And then the second thing you have to remember is, how do you determine legal capital? Well, if you have par or stated value, that's the legal capital. If you don't, then all of it is your legal capital. Right? Make sense? If not, email. So here's your share accounts. You have preferred or common shares, and then if you collected more than legal capital, and that can only happen if you have a stated value. So if you say par value or stated value is $5 a share and you issue them for 30, then you're going to have a legal capital account and you're going to have an excess account. Again, more clear with an illustration in a second. So you can read this as easily as I can. Let's go to the par and stated value aren't used very often. Here's the section. I know this is really not that clear. Essentially what you do is you have capital that was contributed by investors, and it's broken into legal capital for each share type and class, and then the excess, if any, for each share type and class. And then your retained earnings below that. And retained earnings is exactly what it says. It is earnings or profit that have been retained within the business and not paid out in terms of dividends. That's all it is. It is essentially the corporation's version of the capital account. So other than the initial amounts that were raised by issuing shares to investors the very first time, all the other profit and wealth and capital of the business will be found in the retained earnings account. Make sense? Okay, example. So here's the shareholders' equity section. First, let's break them into the two things we have. Contributed capital, which is money that came from investors when we created new shares and issued them to the investors for the very first time, and they gave us money, right? That's the actual act of financing. The second part is the capital you have because you ran your business profitably. So in other words, essentially the capital account for a small business from grade 11, right? So profit we've made that we haven't yet paid out as drawings or for corporation of drawings is a dividend. Okay, so we'll start with the first one, contributed capital from investors. So the share capital is where you put legal capital for each share type and class. The additional contributed capital is if they paid more than any par value. And if you didn't have par value or stated value for your shares, then all of it is legal capital and goes in the share capital section, and you won't have any additional contributed capital. So, example. And before I can even talk about the example, I have to talk about this friggin' long sentence here, right? So let's read it and talk about what it means. Preferred shares, $5, no par, cumulative, 1,000 issued, 10,000 authorized, $10,000. What does that all mean? Okay, so let's unpack that. So these are preferred shares, not common. So those are the ones that must get their dividend before common shareholders get anything, and if the company breaks up in bankruptcy, you get paid first. That's preferred share. $5, no par. What does that mean? $5 means that is the annual dividend. So you get $5 per share per year. No par means the share class has no par or stated value. So that means the entire amount that was raised, which in this case was $10,000, that's it, way over here, right? The whole $10,000 is the legal capital, and because there was no par or stated value, there can be no additional contributed capital. There's no excess. You only have excess if you have a par value and you issued it for more than that. So these preferred shares will have no additional contributed capital down lower. Okay, so cumulative refers to the dividend. Cumulative means if for some reason they don't have enough cash on hand to pay the preferred shareholders their dividend this year, then it accumulates. So next year you'll get 10. One the year after you get 15. And again, the rule still applies. When it comes time to finally start paying dividends again, the preferred shareholders will get all those dividends in full before a common shareholder can get 1 cent. Right? So it's been 5 years, then a preferred shareholder will get $25 before, and all of them will, before a common shareholder can get anything. Okay, so in the brackets, there's been 1,000 shares issued, although the board of directors has authorized 10,000, but only 1,000 have been issued. Since the entire amount raised from issuing those 1,000 shares is in that account of 10,000, you can also figure out that they issued them for $10 a share, right? 1,000 shares issued on average, $10. Boom, $10 times 1,000 is $10,000. Okay, so the rest are fairly similar. So the next one is common shares, 2,000 $1 stated value shares, 50,000 were authorized, 2,000 were issued, and the par value or stated value was $1. So 2,000 times the legal capital, which is a stated value, which these particular common shares have, is $1. So that's $2,000 in the contributed legal capital section. Now, if they were issued for more than that, there will be excess down below. And they were. You can read that on your own. You don't need me to read it in the video. So the journal entry for the share issue of the common shares is, and I make this up, right, is cash $20,000 collected. The common shares are credited for the legal capital of 2,000, right? $1 times 2,000 shares. And then the rest of the 20 grand you issued them for is access to legal capital. So it's the additional contributed capital. So you would credit that $18,000. And this is an example that the shares were issued for $20 each, with a stated value of $1 each. So no, they were also issued for $10. So $10 times 2,000 shares is 20 grand. 2,000 of that, $1 each, was legal capital, and the remaining $9 times 2,000 for a total of $18,000 is credited to the excess. This ridiculously long name, I can't even read it because my microphone's in the way. Contributed capital in excess of stated value. Blah 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 blah. Okay. So then you would plop that into, so this is an example. If there was no stated value, the entire $10, just like the preferred shares, the entire $10 would be legal capital. And so that 2 up there would be 20. And there would be no need for the second section of the green, additional contributed capital. You wouldn't need it because neither share had a legal or stated value, so neither share could have access to that. Make sense? Could it possibly be more confusing? Too many things to remember. I agree. I didn't make it up. It's not my fault. So we're saying it does have a par stated value, right? So that's the way it should look. So there's the money, organized and classed as necessary, that the investors gave you. Okay, so this is your total contributed capital. Totals to $30,000. Done. Okay, fine. Next, retained earnings. So retained earnings, let's say, I made this up, $30,000. That was the equity in the business from running your business in prior years that you started this year with. And the rest looks just like an equity section from grade 11, right? You'd go add net income. Let's say it was $150,000. You would subtract not drawings, but dividends. And you can have 2 types. We cover that in the next lesson, I think. 2 types, cash dividends, or you can actually have stock dividends too. So then you show the change. So the change in retained earnings, not equity, but retained earnings during the year was $70,000. So 30 plus 70 then is $100,000. So retained earnings at the end of the year is $100,000. That's not equity. Got to add it all together. Don't forget about the share capital up top, right? So then total shareholder equity is the 30 of contributed capital from investors and the 100,000 of retained earnings, which is 130. And that's still not the right side of the equation. You still have to add in liabilities. But that's the total of the equity section. Make sense? If not, ask a question. Book value of preferred shares. I don't care if you know this. Skip. Here you go. First stop sign. Try some of these, and if you care, I would suggest, if you want to leave with this section, because it can be tricky, you might need to do, most of them, just to let it sink in. All right. Email me if you got questions. That's it. Talk to you next time.